Coming up, why Australia Post is in the fight of its life, investors react to Nvidia's results, and we wrap up reporting season. All of that and more next. Hi everyone, welcome to the SBS On the Money podcast for this Friday, the 28th of August 2026, a day with the Australian share market rose, the S&P ASX 200 up 0.6%, buoyed by investor reaction to Nvidia's result in the US. We'll have details with Zoran Kresovic from Blueberry Markets soon. But first, to Australia Post, where its CEO says the company is fighting for its life as it continues to battle structural change. It posted a near $32 million pre-tax profit, but that's as a result of property sales, and if you take that out, the underlying business saw a $107.6 million loss. While it's delivering more parcels, it's making less money per delivery because of intense competition from the likes of global marketplaces and international service providers. It's grown its parcel locker network with more than 1,500 banks nationally, but its letters business continues to operate in the red. Volumes have slumped to their lowest since the 1930s. So next week, the cost of a basic stamp rises 15 cents to $1.85 to help mitigate some of those costs. But Paul Graham, its CEO, couldn't rule out further increases, making a $2 stamp a future possibility. So for more on the company's future and what it means for you, I spoke with AusPost CEO Paul Graham. Paul, can we start with the letters business? The price of a basic stamp rises to $1.85 next week, while regular letter deliveries have already been reduced to every second business day. Are Australians effectively paying more for less?
No, they're not. We continue to provide an appropriate service to the community. The $1.85, as you say, is the price of a stamp. That is still one of the lowest price of a stamp in the OECD. We've been able to move the price of a stamp from $1.10 to what will be $1.85, but say $1.70 as it was last financial year. Without that, our losses would have been $500 million worse. And we continue to see letter decline, 15% last year, and we're now seeing letter volumes that we haven't seen since the 1930s.
But you say further price increases and efficiencies will be required. So should Aussies be prepared for, say, a $2 price for a stamp? And what are some of those other efficiencies?
Well, the efficiencies are regulating the delivery schedule to the decline in the volume. Obviously, if you've got a business where your volume's declining but your costs are going up, that's not a good business to be in. We are in that business and we're committed to being in that business through our regulatory process, and we will deliver the last letter that gets delivered. But as I say, we have one of the lowest prices of a stamp in the OECD, delivering to a large geography in Australia. We were able to move delivery from every day of the week, 5 days a week, to every alternative day, and we believe that as volumes decline, we would look to adjust that. The average household receives less than 2 letters a week and sends less than 8 letters a year. So the volume's only going one way, and we have to continue to tweak the network to ensure that we are driving efficiencies at the same time meeting our community service obligations.
But prices will have to rise, right? So that $2 price for a stamp, is that on the cards?
It may do, but again, the average consumer sends between 6 and 8 letters a year. So even at $2, the incremental cost to a household is less than $1 a year, which we don't think is significant. More than 98% of all mail is sent by corporate Australia or government.
Global postal services have responded to this structural change by cutting delivery days further, or community mailboxes replacing some door-to-door delivery for letters, like in Canada, for example. So is that the future here?
We don't believe it is. We think the nature of our suburbs and particularly our regional towns does not lend itself to that solution. And as you say, you've seen the Danish Postal Authority actually stop delivering mail altogether. We don't believe that's the solution. What we do believe is that we are able to hopefully tailor the service to the community need. If the community is getting less than 2 letters a day, it does not make sense to deliver mail every alternative day, and indeed coming from 5 days a week. So we'll continue to look at that volume decline and look at what is appropriate to meet our service obligations, at the same time to drive efficiencies in those losses, because we will always lose money on mail business. And what that will do is allow us to invest more in our parcel business and our retail network.
Property sales supported the bottom line this year, but what about the underlying business? Can that be profitable? Or is there a risk Australia Post will eventually need taxpayer support like we've seen with Canada Post?
Yeah, look, it's a really good question and one that we ask ourselves all the time. We do run a very fine line with a substantially loss-making mail business where those losses continue to increase. We continue to see an increase in costs, be that through our EBAs or just the normal cost inputs that any other business has. We have a growing parcel business, but that business has continued to be in a very fiercely competitive market. We believe we have a pathway to financial sustainability, but it will require the support of everybody who wants Australia Post to be successful, both our shareholder ministers and stakeholders in Canberra, as well as the communities, as well as customers, our licensed post office network. We are in the fight of our lives. We believe we have the pathway through, but it will take a fine balance to manage through that. Property sales have helped us this year. For last year's result, and will help us again this year, but that's a finite situation, and what we are doing with that property sales is investing every dollar of that back into growing and investing in our business. So last year, whilst we sold property, we also built 15 new properties, 10 of which were in regional Australia.
You mentioned that global competition. It's coming from the likes of marketplaces, international and private delivery operators. They're both squeezing margins. So does that mean Australia Post is delivering more parcels but making less from each one?
Yeah, look, I think that is the fact. We are seeing intense competition exactly from who you mentioned, global marketplaces, new competitors that weren't even in the marketplace 2 years ago coming in and offering very cheap prices and targeting our metropolitan volume, which is obviously the substantial volume that we have. We continue to be able to service and want to service the whole country, and we're very, very committed to that. But those margins are being squeezed, which is why we need to continue to invest in our parcel business, invest in more efficient facilities, invest in new technology, invest in new fleet and vans to drive down our fuel costs. So it's a combination of a lot of areas that we need to invest in. And our key goal every day is to make sure that we're providing small to medium retailers, Australian retailers, with the best chance they have to compete against the global platform players.
Those efficiencies, how does AI fit into that?
Look, it's a component of it, and we're no different to any other organisation that we are working with a number of AI models in our business. We are only in the nascent stages of that, and we are discovering the opportunities that it may be able to provide. The predominant focus for us in our operation is obviously frontline. We've got people out there delivering mail, delivering parcels, providing service over the counter. Those jobs will not be impacted by AI, but we can see efficiencies that it can drive in our financial systems, in the tools that we use for reporting and getting insights to our business. But we're in those very early stages, taking baby steps, but certainly we see it as an opportunity and one that we will explore like any other business in Australia.
So with pressure to cut costs, can you guarantee that won't come at the expense of regional, rural and remote Australians, and that you'll maintain at least the 2,500 post offices in those communities?
We're absolutely committed to that. It's one of the foundations of Australia Post and who we are, and we have committed to the 4,000 retail outlets across Australia, of which 2,500 of those are in regional, rural and remote. In fact, I was up in the Torres Strait Islands a couple of weeks ago visiting one of our remotest post offices in Bamaga and in Horn Island and Thursday Island, and it just reinforced to me the essential role we play in providing those communities with essential goods and communication. So we are absolutely committed to that. What we have to do is continue to invest in those essential services whilst investing in our parcel network and balancing a loss-making mail business that we have a community service obligation in relation to, and to maintain that. So it's a balancing act. We think we have a way through it, but as I said earlier, it will require the support of all our stakeholders to get behind Australia Post to make sure we come through that period of significant transformation successfully.
And just finally, what does that support look like?
Well, it looks like continuing to use Australia Post as a service first and foremost, use our bank at post services, particularly support our licensees in both metropolitan and regional Australia, and continuing our dialogue with the government in relation to what we think are practical reforms in relation to the delivery of mail and how that should decline on a logical basis in relation to the volume decline, and also continuing to make sure that the community understands the essential role that we play, and that we're committed to that role, but also the recognition that the world is changing. Their habits are changing as to how they consume and use our services, and therefore we have to change with those habits to make sure we're contemporary, providing the essential services they require, but also being able to invest in the new services that they're demanding of us. So in the parcel business, as we know, it's about convenience, it's about speed, it's about 24/7 access. We have to invest in enabling that, particularly for Australian retailers to compete. But at the same time, those core essential services that people know us for, bill pay, bank at post, passports and mail and parcel services across those 4,000 outlets, they are important and critical, and we need to invest and preserve those also.
That's Australia Post CEO Paul Graham speaking there. To the Australian share market now, which finished the week stronger. The ASX 200 up 0.6% to 9,092 points, led by tech stocks. Xero up by 4.8%, WiseTech 2.7%, and NextDC 2.1% firmer. It followed a near 8% surge in Nvidia, the world's largest listed company, in the US overnight, as investors react to its results. So to find out more, I spoke with Zoran Kresovic from Blueberry Markets. Zoran, so the market is up today, follows a tech rally in the US and blockbuster results from Nvidia. So how significant were those numbers, and what does it mean for the market and the AI story?
Very significant, Ricardo, and we've seen kind of the offspring of that coming through the ASX today, where out of 11 sectors, we had 8 up for the day. Market is actually about to wrap up around 30 points up, 0.25%. And the leading sector is technology, obviously, being 2.85% up. Obviously, that's kind of flooding through from the overnight results when Nvidia actually gained 7.8% in NASDAQ, obviously pushing up the NASDAQ composite around 2.3% up in the US. So very, very significant. I think the results actually pave a way and provide a little bit of clarity and I would say probably confidence into the AI narrative, because I think the question prior to the Nvidia's results was, is this AI bubble about to come to an end, or whether this is actually something that's going to be prolonged and last for a little bit longer. Nvidia's results were exceptional. Obviously, Q2 results at 92.8 billion in terms of their revenue, being up an expectation of around 106% year on year. Q3 expectation is around 100 billion. So we'll be watching this very, very closely. Revenue is exceeding the expectation of what the market was kind of acknowledging of 45%. We're going into the new financial year. And the results have been actually kind of expanded, and so expectation is that Nvidia will be gaining around 75% revenue upbeat in the financial year 2028.
The other thing that's been pretty solid over the past few days, or past few weeks actually, is the Australian dollar, and it cracked 72 US today. What does it mean for the markets? It's at its highest in about 3 months, and what's supporting it?
Yeah, so that's an interesting one, because at Blueberry we talk a lot about the Aussie gaining quite a bit of momentum and being up 8 weeks in a row. It's been astonishing results. I guess the key fundamentals and key narrative here, Ricardo, is the interest rate expectations going into the year end. We've actually seen CPI data earlier in the week coming hotter than expected. A lot of economists are expecting, or 56% of the economists are expecting that we will get an interest rate hike in the month of September when the RBA meets on 29th of September. So that's been actually priced into the market around 60% chance. We actually have a 14% chance that we will get back-to-back interest rate hikes coming in September and November, which would be obviously quite bullish for the Aussie dollar, definitely, and something that investors and traders would be actually looking at very, very closely. I think other components are the consumer confidence actually is actually been a little bit subdued, but overall the sentiment is that our inflation numbers are actually still quite hot. We are way off the mark when it comes to the RBA's narrative and mandate of bringing that in line to 2%. We still have to do a lot of work to slow down the economy, and on the back of that, Aussie is actually doing exceptionally well. So we do anticipate that we will get more bullish kind of results, and Aussie will continue its upside rise. And we probably don't sustain or don't expect Aussie to actually slow down anytime soon.
Profit reporting season's basically coming to an end. I think you had the likes of Virgin Australia, Harvey Norman, Air New Zealand, the laggards today. Now that we've come to the end, how would you rate it, and what do you see as the key themes?
Yes, I mean, if you ask me, and I'm a school teacher, I'd probably give it a rating of B or B plus when it comes to the reporting season. I think vastly we have actually set and kind of meet expectations in terms of the results and earning numbers. I believe around 44% of the companies on ASX have somewhat hit the mark in terms of obviously the earnings side of things. 26 have actually somewhat missed. 50% of the companies on ASX have actually kind of risen above 5% once the numbers were announced. I think we need to put it in kind of two separate buckets here, Ricardo. Number one, we've seen disappointing results from the banks. We do understand that obviously top four banks provide a lofty amount of the ASX weighting, predominantly driven down on the loan write-ups. So Westpac is actually kind of expecting that component of loan applications will go down to about 20%. ANZ is expecting around 12% downside. So that's kind of set the narrative for the banks to be not doing as well as expected. I think that's probably one part of it. The other part is also that we've actually seen consumer discretionary sector that hasn't done the best as well. We've seen the likes of JB Hi-Fi and Harvey Norman not quite hitting the market expectations because the consumer confidence in second part of 2026 has been actually kind of somewhat lower on the lower scale of things. Obviously, interest rate expectations, surplus, budget that came in May are all playing a big part of that. But there is some positives as well. If we do consider and take into account some stuff such as healthcare, CSL has done exceptionally well. CSL post results had an upside run of 17%, which was astonishing, and Cochlear too. So it's a bit of a mixed bag at the moment. I think the 2027 expectations on the reporting seasons have been subdued and cut back by 2%. So we do expect actually the market to kind of dial back a little bit because there is quite a bit of uncertainty happening. Material sector is another one that's been somewhat actually providing some solid headwinds because we have seen copper prices actually do exceptionally well over the past few months.
And Zoran, in wrapping up, what are you telling your clients right now, and where do you see the opportunities for investors?
Well, Ricardo, we touched on it slightly earlier. I would probably see a lot of opportunity in Aussie dollar at the moment. I think Aussie is one that's going to outperform all the G10 currency pairs. In particular, I'd be looking at probably Aussie dollar versus Japanese yen. A lot of investors and traders are actually trying to take the advantage of, what's considered a carry trade, offsetting the higher yielding interest rates to the lower yielding interest rates. In this instance, it's obviously Aussie dollar because RBA and market is expecting at least another interest rate hike. BOJ or Bank of Japan, inflation numbers have come out this week as well. They are slightly ahead of the curve, and we can expect probably Bank of Japan to raise rates in the near future. But overall, the squeeze and the opportunity is still there for Aussie dollar. Alternatively, if looking to potentially hedge against any Middle East concerns or any tensions that might come through over the next few weeks, I think we're actually seeing quite a bit of flow coming into the gold. Gold has been a star performer from around start of the month or 5th of August. It's actually gained substantially, and we are actually seeing quite a lot of backdrop and positive news coming into gold and some of other commodities as well.
That's Zoran Kresovic there from Blueberry, and he wraps up the podcast for this Friday and for the week. Don't forget to give it a like, a review, and subscribe if you do enjoy it. And don't forget you can watch On the Money during the 6:30 weekday edition of SBS World News. The podcast returns on Monday. It drops after the market close, and I'll catch you then. This SBS On the Money podcast is provided for informational purposes only and should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decisions.